thank you all for joining us. Obviously, this is a pretty hot topic right now. The new administration and our market outlook, as you can imagine, even in the recent, probably last few weeks, the call volume has risen quite a bit. So I really wanted to address what's going on in the markets. But before I kick off, first of all, I just love this Circa 29. This is a great venue here in the S&W cafeteria building. Anne, who is the owner, has been wonderful, and they just are very accommodative, and the catering is also wonderful. So appreciate all of that. I do have some team members here. Of course, I think many of you all know Betty Nolman and Elena Schuler, and those two, I just want to say, have been so wonderful in keeping us organized, keeping our processes in place, and keeping us sound as far as working through this tax season, which is always everybody's highlight right now. So I appreciate both of you. And of course, Laura Webb is with us. And Laura, she went to the UNC Duke game yesterday and still made it to the seminar today. So I appreciate Laura being here as well. And then finally, Megan Holly Slaughter is with us. She's been here to support me and came down this morning with me. All of that to say, I'm really excited about giving some information and having some discussion on this topic, but I really want you all to understand that I love for this to be a discussion. So I really want you all to think about comments, questions, things that you've been thinking about through this first almost 90 days of the first quarter. We'll be completing the quarter at the end of this month, and it's been a pretty wild ride so far. So I want to kick off by just talking about where we are, by going back and just kind of giving a slight recap of the end of 2024, because as we moved through the election, which typically we get volatility in the market whenever it's an election year, and I'll say we didn't see as much volatility as we were anticipating last year. But part of that was, we still saw an economic environment that was positive. They had first looked at the GDP for the U.S. economy in the fourth quarter last year. It was up about 3.1%. They recently revised that down to about 2.4%. So still good growth and above trend growth as we saw fourth quarter wrap up last year. So that brought us to 2025 and a new administration coming in. And as we all know, when new administrations come in, whether it be the Republican Party or the Democratic Party, things do get a little volatile because the uncertainty that is created by new policies, comments, or visions that a new administration would have. So I'm not going to say that this is different, but as we've seen the Trump administration move in, I think what we're experiencing is more demonstrative action, maybe in a way that we haven't seen as a society, as he's had people come in that we're not used to seeing. For example, Elon Musk. He wasn't an elected official, but he's come in as an appointed role in a situation for Department of Government expenditures. We've seen a lot of executive orders. We've heard a lot of talk about trade and tariffs. So I think a lot of that volatility is created because it's been a little bit more demonstrative and probably in a way, again, that we haven't experienced. But let's just take a look at what we've been seeing and why that this is top of mind for our clients and investors. Number one, right now, if you look at the VIX, and I don't know how many people have heard that talked about. So the VIX, VIX, is just a volatility index. And it's just something that we can look at. People can actually trade the VIX, but it really gives us a little measure of how much volatility is happening in stocks. And typically in a low volatility environment, we might see the VIX trade around 10 to 15. And all of last year, the most the VIX traded was 16 times. So not a lot of volatility even in an election year. Right now the VIX over the last 6 days of trading has been plus or minus 1%. We haven't seen that since the eve of the 2020 election. So you can imagine that things are a little bit heated up right now. When you see the VIX index moving plus or minus 1% over a 6-day period. Secondly, that VIX index has been trading around 25 to 30. So you can see it's almost double what we've been experiencing. And again, I think that's why it's top of mind what clients are feeling right now. The other thing that we can look at and say what's going on with the volatility and what's happening is really when we start seeing economic data coming out. And as we've entered this first quarter of this year, we're actually seeing a contraction. We're tracking right now on the U.S. economy at a negative 2.8% contraction for our economy. Now, part of that may be that we saw imports surge at the end of last year in anticipation of what the Trump administration said they wanted to do with tariffs. So as tariff talk began at the end of last year, many CEOs made the decision, I'm going to start gathering some of my goods now and maybe even warehousing them, knowing that we might see higher costs in the future. So that surge of imports, so we're not getting that data put into this quarter. That happened for the fourth quarter last year. Secondly, the wildfires in LA, in California. That was a real economic dampener as people and citizens in that area, businesses shut down, small businesses, which is a big part of our economy, small businesses shut down. And so that kind of softened the economic data, has softened the economic data as we moved into this first quarter. And then finally, just cold weather. We had that really cold spell, and if you're like me, when it's cold weather, I prefer to stay in and not go out shopping. So I think those things have contributed to the contraction that we've seen so far, that where we're tracking for this first quarter. And that's a bit scary, because when you see a contraction in the economy, obviously corporate profits will probably soften as well. So as we look at this environment right now and where we stand, I'm going to give you two things to really focus on, because all of this chaos and uncertainty create emotions for us as investors. And so what we're going to try to do is clear off the emotional part and really focus on the fundamentals. And that's where I want to kind of talk about the two sides. What are the negative impacts of the new administration to the market, to the economy, and what are the positive impacts? And some of that I want your feedback into what you're experiencing, and some of it may be emotional. You know, we are emotional when we see things happening that don't make us very comfortable. And certainly the stock market does not feel comfortable when there's uncertainty or chaos. So let's take a look first at some of the negative impacts that we're seeing from the current administration and what they're doing. One we'll talk about, and is probably the most in the headlines, and that's tariffs. So tariffs are just obviously taxes on goods, whether they're coming or going. So what the Trump administration is doing right now, and as of March 4th, last Tuesday, he began to put tariffs on Canada, Mexico, and China. Now China, he had already instituted a 10% tariff on Chinese goods, basically across the board. Tuesday, he announced 25% tariffs on Mexico and Canada, again, across the board. Now, the reason part of this gets to be a little chaotic is on Wednesday, he changed his mind slightly and said, okay, no, on automobiles, there's going to be no tariffs. And then on Thursday of last week, he said, okay, we're going to delay the tariffs and we're going to push these out, and they'll start again April 2nd. So you can understand that, number one, blanket tariffs, when you just do tariffs across the board on all goods, that will create a trade war, and that is no good for any of us, whether it be the U.S. economy or the global economy. That will really sink the global economy. So blanket tariffs are no good. So I think the second thing in that part of the negatives that are out there is that with those tariffs, you're going to see the contracting of our economy. So spending does slow. More importantly, if you could imagine as a CEO or somebody trying to run their business, if they're getting any products or manufacturing any of their goods outside of the United States, they're concerned. They don't know how to make decisions for the next 3 months, the next 6 months, or the next 12 months because they're not sure what those costs are going to be. And so sometimes we delay things, and that's going to, you're going to see that negative impact on the delay because of this kind of uncertainty. Another thing that would be a negative impact is just what I had mentioned earlier, the chaos that's surrounding what we're seeing in Washington. And I say chaos because some of the things that we're seeing happening right now, whether it be how they're implementing tariffs, and again, the president has the ability just to do those with an executive order. He does not need Congress or Senate to sign off on those. So those executive orders can come and go pretty quickly. And so that ease of being able to make those changes creates a little bit of chaos. Secondly, when we hear things that are going on that are unusual in Washington, that's going to create some uncertainty and chaos as well. I think all of us feel a little concerned as to what are they trying to do? What is the end goal to this? So when we think about the tariffs, you know, what President Trump has said is we want better trade balance. You know, this is an imbalance with some of these other countries in trade. Secondly, that he's talked about national security is part of the reason. National security because, you know, just think about COVID when we were needing semiconductor chips, but most of our semiconductor chips were made in Asia and specifically in China. So they talk about national security. They also talk about national security, and this one is kind of new, these last two. Pharma, I think President Trump has been concerned with tariffs or using tariffs to control fentanyl and pharmaceuticals that we do take that come from other countries. That's been a big concern as far as what he considers national security as well. So that's a little different than when he was in office back in 2016 and implementing tariffs. He's using some other things as reasons why this term. So those tariffs are going to create a negative impact because, as you can imagine, the other negative we have right now is inflation is starting to increase a little bit. Okay, we actually saw inflation data in December get a little sticky, and that's why we felt that we would not get the interest rate cut from the Federal Reserve in January, which we did not. I was anticipating an interest rate cut this month, but after getting the inflation data for January and February, and now inflation is now 3%, so we've ticked back up. You know, we got it down to about 2.4%, but now it's 3%. That's a negative for the economy, okay? Obviously, as consumers, we make up 70% of our economy. Us just going out and consuming and spending and buying. If we as consumers are feeling uncertain, or we're having to pay more interest to buy vehicles or homes, we're going to slow our spending down. So higher inflation is another impact that we're seeing negatively on the economy. So I don't know if any of you all have any feelings of what you feel is negative based on what the administration is doing. Are you feeling it in your everyday lives, or is it more just, hey, the headline news are just making me feel a little uncertain?
Absolutely. We were thinking of buying another home to be closer to our daughter, and now because we don't know what the administration is doing, we've cut back. And as far as emotional decisions, I'm an artist and I can't help it. So.
Oh, that's good. Completely understand. So we had someone mention that higher inflation, the uncertainty is postponing perhaps a house purchase. And it's interesting because housing had one of the biggest drops. It was down 10.8% in January. That's an economic contraction. Now, some of that is due to supply, and obviously when you have fires, wildfires, hurricanes, things of that nature, natural disaster.
Absolutely. Look
Yeah.
at Asheville and western North Carolina.
North Carolina, exactly.
And I'm sure Florida is having the same problem as
Yeah.
well as
Yeah. And then you just have natural attrition from homes that have deteriorated. And then we have, we're not building enough homes. We need to, as a country, build 1.5 million homes every single month to keep up with demand.
And
We-
the problem, I'm sorry,
No,
I'm
go
interrupting
ahead.
you, but
That's
the
okay.
problem is finding skilled workers.
Yeah.
So a lot of the people that used to build homes are aging out,
Yeah.
and we don't see a whole bunch of a new crop of builders.
Yeah. And even skilled workers, like you said,
Yes.
coming in to work for contractors. And, that could potentially be another negative impact as we start to see deportation of immigrants, because a lot of immigrants do work in the construction area.
Absolutely.
So-
And the agricultural.
Yes.
Yes, and agricultural. And, obviously, there's tariffs now on China. When he doubled the tariffs, he had 10% in January, an additional 10% last Tuesday. And a lot of those weren't agricultural goods from Canada as well as from China. So a lot of those kind of things are what is creating this real angst. And remember, as I said, the stock market is a forward-looking indicator. It's one of our better economic indicators because it looks forward 6 months. Some of the data we get, like housing and things like that, some of that is lagging data. So that's what's happened. But again, both are data that we can use to kind of forecast and prognosticate what's to come. Okay? So in this, though, right now, this has created a huge negative impact to the markets. So as we started January, coming off, as I said, an economic growth of around 2.8 to 3% for 2024. They're still doing some revisions, that's why we're not exact yet, but they're still doing some revisions. But still coming off a fairly good economic environment. We're coming off of 2 back-to-back years of 20% growth in the stock markets. And as we enter January, feeling pretty good that we're going to continue to get some rate cuts from the Federal Reserve. Most economists were thinking 2 to 3 rate cuts this year, which is good for the economy, good for stocks. January was a really good month for stocks. So we saw the S&P 500 up a little over 2.5% for the month of January. The Dow Jones, which is only 30 stocks, all value stocks, was up nearly 5% for the month of January. The NASDAQ, which is another index, it represents a lot of growth stocks, like those big mega cap tech stocks. NVIDIA, Google, Amazon, Tesla's part of that index. That index was actually a little negative. So when you think about that, because it's a pure growth index, maybe the market was already telling us something then. Because the indexes that were so positive, the Dow, which is 30 stocks, but it's value stocks, the dividend payers, the consistent dividend payers. The S&P 500 wasn't up quite as much because it has growth and value stocks in that index of the largest 500 companies. Yeah, Dave.
Am I correct in thinking if inflation holds at 3% or goes slightly higher, will the Fed not lower?
Correct.
That's what I thought.
Yeah, that's a good good point. If inflation were to stay here at 3%, or move up, and I will tell you, I have said I don't think we're going to get this rate cut in March now.
I don't think
because
so
the
either.
data, yeah, because the data. Honestly, I think we're gonna see at the end of the year, perhaps a Fed rate hike based on the information that's coming out of Washington and based on current data we're seeing. Now, that could all change, of course, and I would, I think the likelihood is it will, and here's why. So we've talked about the negatives of these impacts. Let's talk about some of the positives, okay? So we've got a Trump administration that told us, hey, I'm gonna lower corporate taxes. Lowering corporate taxes from 21% to 15%, that's gonna be a positive because corporate earnings are gonna have a better profit margin when they're saving 6% in taxes, okay? Secondly, deregulation. So Trump has said, we're gonna take some of these regulations off so that we can have more flow in business, in particular, more mergers and acquisitions, okay? Which tend to be good for the economy as well. Thirdly, and Dave, I think you might make a comment on this because we had talked about AI. So thirdly, right now with our economy, we are seeing productivity growth because of innovation, and innovation, I should say, because that's another positive. And then also with that productivity growth, what we're seeing is more efficiencies in the economy as being a plus. So innovation, productivity growth, and the last thing I would say is AI. So AI has given much more efficiencies to companies based on that tool, and we're seeing a huge growth continue in AI. Because some of these mega cap tech names, that even though their stock price may be down 10, 20% this year because of all of the tariffs and everything that's going on in Washington, they are still investing large amounts of money in capital expenditures to grow AI, to grow those semiconductor chips that support AI technology.
But as you read in that article, it's a two-edged sword.
Yes, very much a two-edged sword.
There are capabilities and possibilities in areas like reviewing medical research and diagnostics that show a tremendous amount of promise, but there's also the capabilities of deception and misinformation generated that way as well.
Yeah, Dave shared a really good article with me, and it talked about AI is a great tool if used responsibly, and it talks about responsible AI, and obviously movements in medical technology and pharmaceuticals, and how we conduct business, just getting more productive and more efficient. But the downside to some of the AI technology is also the ability for people who want to use it for I don't want to say evil, but it's for the bad, like getting hacked.
Yeah.
And I know, Terry, we were just talking about some of the issues you've had even in banking. But AI is getting so good, and in this particular article, it talked about how AI can now do images of people's faces and take those images and replicate the voice.
Mm-hmm.
So as you can imagine, getting someone to call or having that call come into the bank, and the bank them saying, hey, I want to move X number of dollars over to this account, and it feeling real. And so that's where we do have to be very cautious with that growth, because I think it can be very beneficial to our society and to the global economy as a whole, but we have to be very careful.
And corporations like Raymond James that serve clients need to stay ahead of that,
Yes.
not wait to get blasted and say, oh, we gotta fix that.
Right. And it's a concern, as we've seen the Pentagon hacked, we've seen major corporations hacked, so it's always a concern, and we do talk about, and I think that's one of the things that clients want to know about is just how secure are we with Raymond James? And I think that's where one of the places Raymond James does shine, how proactive, as I discussed with Dave, how proactive Raymond James is with our technology and our security and our accounts. It's one of the things that they do very well. But it's a never-ending challenge because as AI gets better and hackers get better, because the things we're seeing today, we wouldn't have necessarily seen 10 years ago. You know, I get links.
ago.
Yeah, you get links that, yeah, 2 years ago. That's how quickly it does change, because you get those links. You know, I've seen those links that look so real from Microsoft, because they've got the Microsoft logo or the Apple logo, wanting you to click on that. And the one thing that I try to discourage clients, I say, do not ever click on a link unless you have verified that link, because it is very dangerous what we're seeing. So, what other positive things are happening that from either the Trump administration or what we're seeing in this technological growth? As I mentioned, the innovation, AI, we also mentioned productivity growth. As a society, we're becoming more productive in what we're doing.
Well, you mentioned that the president can institute tariffs or suspend tariffs at the stroke of a pen, and having decided to do it and then defer it and then do it and then defer it. I think all the marketplaces are saying, make up your mind, because that uncertainty is what is raising that question of validity. Which is it?
Yeah.
Invest in Waffle House.
It seems like we have that uncertainty on every front of this administration. Which I wouldn't put it. Number one, on the tariffs, he can raise tariffs with an executive order only if there's a national emergency, which is why we got the fentanyl balloon.
Yeah.
So he can't just be able to do it, but he is peopling himself with a crowd of, I don't know how to describe them. They live, they breathe, they don't know what they're doing.
Yeah.
And I cannot see a bigger formula for catastrophe, let alone uncertainty ahead of us.
Yeah.
And as someone who would try and plan ahead in a business, I don't know where you begin.
Yeah, I think that's a great statement, and that's what I hear a lot from, like, if you're watching any of the market news and them bringing on CEOs and interviewing CEOs, is the fact that they don't know which step to take. You know, because if these tariffs are happening, you know, so quickly and in a blanket perspective, and then being rolled back and then pushed forward. And I think that's part of the administration's leverage, is just that, hey, I'm going to go ahead and do this large tariff and across the board, and more of a, you know, a big stance, and then roll that back.
After he figures out what it is.
Yeah, yeah,
It's like a kid with a pile of blocks.
yeah, yeah, yeah,
And people need to remember that if the rationale is so that more manufacturing comes back into the United States, that takes 2 to 3 years. There's no such thing as instantly building a factory and building the equipment and finding the employees to do that. It takes 3, 4, 5 years. Look at how long it took just to get Pratt & Whitney
yeah,
factory built, and they're still staffing it
right,
because of that. So to say, well, we'll put a tariff on that car coming from Mexico to the United States so that it's built in the United States, don't hold your breath. It'll take
yeah.
a long time.
Yeah, because that is one of the reasons they give for tariffs, is to bring manufacturing back to the U.S.
But they need, no matter what it is, it takes years, with all the conditions being right to even make that happen.
Yeah,
In the best of all worlds. I mean, I think there's a basic lack of understanding of the administration as to what a tariff is. And it is a sales tax. And, I
It's
find it
basically
kind
a
of-
readjustment of economic advantage is what it is.
yeah,
I don't think our president understands what it is to be a president, to tell you the
not at
truth.
all, not at all.
He doesn't understand his responsibility to our country. It's only his selfish ways and means. I mean, he thinks that he can just sign away whatever he wants, and that is completely not what I'm used to a president doing. And I'm sorry, I'm coming from an emotional.
no, that's okay.
You know, he wanted to turn Canada into our 51st state, he wants
Yeah.
Greenland. His last administration, he wanted to sell Puerto Rico. I mean, and he's pissed off all of our allies.
Yeah.
So, how are we supposed to make
Well,
some
I
decisions?
feel like that part of it is saying then, what are the things that we can do, or how do we look at our investments, our portfolios, you know what I mean? What are your thoughts with given this chaos on,
Well, that's good. So now we'll talk about the bottom line. We kind of talked about the negatives and the positives and, you know, what is actually happening. Because the stock market right now, when you look at the S&P 500 index, which is generally what we use as our gauge, because it's the largest 500 companies, there are growth companies and value companies. And by the way, it's skewed, it's cap weighted, meaning the larger the company, the more impact they're going to have on that index. And that's why growth style stocks have been such a big part of the returns that we've had over, you know, 1 year, I think it was in 2019, 70% of the return of that S&P 500 index came from 7 companies. That's what they call the Magnificent Seven, the 7 largest tech companies. Last year, 58% of the return came from those 7 companies. This year, they're actually detracting from their return. And that's the interesting thing, because their growth and more people are moving towards value, and probably because they're looking to see an economy that's going to contract and moderate. So we're going to see a slower economy this year. So let's talk about the bottom line, because what you're saying, no matter what party you're for, Republican or Democratic Party, you know, history shows that the markets do fine under Republican parties, the markets have done fine under Democratic parties. I typically tell clients, because when it all comes down to it, who has a bigger impact on stock market returns? The Federal Reserve. Because the Federal Reserve's mandate are 2 things. The Federal Reserve has 2 mandates: employment and pricing. So, you know, obviously stability of prices is part of their mandate and employment is part of their mandate. And they will raise rates or they will cut interest rates to keep those at a level that is consistent. So remember, their target was 2% inflation, so they were cutting interest rates to get us down to they were raising interest rates to push the inflation down. And once we got it down to 2.4%, then they began cutting interest rates. And I left that out because that is a positive for the markets. So you remember, it was September, we got a 0.5% cut from the Fed. And then again in November, we got a 0.25%, and December, we got a 0.25% cut from the Fed. Cutting interest rates boosts the economy, and it takes about 12 to 15 months for those interest rate cuts, or if they're raising rates, to work themselves through the economy. So we're going to have the benefit of those rate cuts for the next 12, 15 months. So going into 2026, and it may be something we really need if we continue along this tariff path. But going back to what I said is the bottom line. So what do we do? Like Laura said, what our role is we try to take the emotion and set it aside. Because we're all emotional, whether it be our candidate that
I'll
won
sit
or
over
our
there.
It is, and we're emotional, even if it is our candidate that won or our candidate that didn't win. It's still impactful about what we're hearing coming out of Washington. It's emotionally impactful. And so trying to set aside the emotions and really focus on the fundamentals. And the fundamentals, you know, we want to look at are corporate earnings and the economy. Because where the economy goes, corporate earnings usually go. And I will tell you, if you look at any stock market chart, whether it be a 20-year, 30-year, 75-year, the stock market chart, it's like this jagged line, but it just goes up, okay, over time. And that's because corporate America, especially when you think about our large companies, do grow their earnings over time. Sometimes they have a bad period, but over time they grow those earnings. So we talked about the negative impact to those earnings. We've talked about the positive impact to those earnings. What we find is most plausible at this time, you know, here we are March 10th, so we haven't even finished a full 90 days of the new administration yet. Because, you know, in those first 90 days is when any new administration wants to get their policies rolling and potentially in place. Because again, we got another election year coming next in 2026. And a lot of the congressmen and women don't want to be making bold changes, perhaps because they may not get voted in the next year. So what we find is plausible is to see more specific tariffs, not this broad tariff impact that Trump has put out so far. So we do feel that what is more likely to happen is they will negotiate and there will be specific tariffs on specific goods. Okay? Tariffs aren't going away, but just not as broadening as they've been laid out so far. Because a broad tariff just, like I said, it just creates, it would create an economy that's going to go into a recession if you have a broad tariff. Okay, so I think it's going to be more measured and on particular items. Secondly, the other part of it is corporate earnings right now have been pretty solid. And we do think that is going to continue throughout 2025. So wrapping up the first quarter earnings, essentially we wrapped those up in the last 30 days, had our last reports. We actually had corporate earnings solid and even outlook. Most companies' outlook for the remainder of the year was stable. Some increased, some decreased, but most of them were pretty stable in their outlook. Okay, our estimate is to see corporate earnings, and when I talk about corporate earnings, I'm talking about those large 500 companies that represent the S&P 500 index. Those corporate earnings last year were up 16% versus the year before. This year, we think that's going to moderate just a bit, and we anticipate seeing about 11% growth in corporate earnings, because we do expect that the economy is still going to grow this year. Little concerned that we're seeing the economy these first roughly 70 days, or 60 days now, track at a negative 2.8% contraction. But again, that some of that can be explained because of, you know, we fast forwarded a lot of our purchasing of imports in December, so that gave way to a slower quarter. Wildfires and weather, I think, also kind of dampened the quarter. But we still believe that by the end of the year, we should have economic growth in that 2.1 to 2.3% range. Okay, so a little more moderate than what we saw in 2024, because 2024 is shaping up to be around 2.8% growth for 2024. So a little bit more moderate, but that's still very solid growth and should give us that 11% return in corporate earnings. And if we have that, we can kind of estimate for the S&P 500 a return of maybe the upward single digits in the 7 to 8% area. Okay, now that's my view based on the data we have right now. That data can change, and I'm making the assumption that the likelihood is that these tariffs are more specific, not so broad. And so if that were to happen, that's kind of what I feel will be the outlook for the economic forecast as well as the market forecast. Now I'll tell you, that could very well change. I mean, we still have a lot of the year to move through, and what companies have been saying is they feel like first quarter earnings, when they begin reporting in April, should still be pretty solid. And if those things continue to hold true, then, as I said, I think we'll end up with a positive year. Now, one thing I'll tell you, January, excellent month. As I mentioned earlier, that the Dow was up almost 5%, the S&P was up a little over 2.5%. The last few weeks, we've given that up. And right now, the S&P 500 is negative for the year. We're down about 0.5% for the year. The Dow is still slightly positive. I think it's up about 0.25%. And the NASDAQ is down almost 7%. So those big growth companies. So you can see what investors' minds are thinking right now. The economy contracting because growth stocks have a huge headwind when the economy's softening up. Yeah, Chris.
You're leading into a question I was going to ask you
Good.
before. I think partly you already answered it. I look at this from a perspective of about 50 years. And share prices go up and go down, or go up overall. Share price fluctuations don't concern me. My question has been in the last few months, will anyone start cutting dividends? Dividend income to me is more important right now than share prices.
Yeah, excellent question. Will companies start cutting dividends because of perhaps a more softened outlook based on where economic data is driving right now? Very well could happen, Chris. That's why, we want to focus. We do run a dividend strategy in-house. What we tend to focus on are those companies that not only pay a dividend, but raise their dividend each year and have a history of doing that at least the last 10 years. But more importantly, that we feel based on their earning cash flow and where their dividend payout ratio is right now, that they'll be able to continue to raise that dividend as we move forward. But that's certainly something that we have to pay attention to, because when companies start cutting dividends, and those value companies, that's a real bad sign.
Yeah.
Because they're the ones that, that's the last thing a company wants to do is cut their dividend, because obviously the stock price is going to fall. My concern is if these CEOs aren't given any clarity because of all of the tumultuous behavior we're seeing so far in Washington, if they're not giving clarity of a direction that they feel the administration is going or where Washington is going and what their vision is, they may start cutting dividends because they may want to shore up cash. They may want to put some more cash in reserves for that cautious outlook. So that is certainly something we'll pay very close attention to, Chris. Also the portfolios, as Laura has always done with our clients, is we've been in really balanced portfolios to kind of protect from markets like this. The good news right now, the bond market, many of you all hold bonds in our portfolios, okay? And it's interesting to me to see with inflation, the thought of inflation because of tariffs, because of where we are in the economic environment, if we're projecting inflation to go up, the 10-year treasury should be going up. So that's interesting and something to pay attention to. So the 10-year treasury yield at the end of last year started moving up. We were trading around 4.3% in treasury yield around June of last year. By November, it had crept up to about 4.7%. So you could get the 10-year treasury, very safe investment, it's issued by the federal government, and get 4.7% on that 10-year treasury. That's usually investors saying, here's what I want for my interest rate return if I'm going to give you my money for 10 years, because I think there's going to be inflation, so I need a higher rate. That's why we typically see the 10-year treasury yield go up if we're anticipating higher inflation in the future. Well, guess where the 10-year treasury is right now? It's at 4.25%. So that's kind of like, wow, what is going on? I feel it's not because of it, we don't fear, or it's not because we don't think inflation's going to go up. I think it's because we are fearful. Where do people go when they're afraid of stocks? They go to bonds. They say, hey, you know what? I'm going to just take some profits off the table and move out of stocks and move into bonds and get safe because this environment's scaring me. So this is more about fear with the 10-year yield going down than it is our anticipation that inflation is going to be going up. Because I don't think you could find many economists out there who do not think inflation is going to creep back up a bit. Most economists are kind of giving the forecast to see inflation around 3.5% by year end. Okay, doesn't sound too bad, especially, you know, right after COVID, back in October of 2021, when the Fed thought inflation was transitory, and it wasn't, but we crept up to 9.1% then. So to get it down to that 2.4 and now see it creep back up, that's why I don't think we're gonna get any more rate cuts this year. But if it gets to 3.5, that's gonna be a bit worrisome from the Fed. And we might see a 0.25% increase if it does creep up there. Because their target, again, they want inflation for their pricing stability model, they want inflation at 2%. That's their target, okay? Yeah, Lisa?
Back to dividends.
Yeah.
If companies stop or reduce payments for dividends, which we are pretty much dividend based, what does Raymond James suggest we do? Buy bonds?
Perhaps, yeah, that's a great question. So the question is, if we start to see these companies cutting dividends, where do we move to get income? And generally a great place to go are bonds. Now, if you recall, back in 2022, when inflation hit October 2021, 9.1%, and the Fed started this aggressive cycle of rate hikes, and it was aggressive because they were raising by 0.5%, and we got 11 rate hikes. And it put the Fed funds rate up to 5.25% to 5.5%. We haven't seen that in a long, long time. It was well before 2008 that we saw the Fed funds rate that high. When you get aggressive rate hikes, bond prices, the prices go down. Interest rates go up, bond prices go down. So when you look at your bond value, it's a lot lower, and that's scary. Now, if you hang on to that bond until it matures, you're gonna get your principal back, okay? But it's just scary seeing your bond portfolio pricing go down. And what happened in 2022, when the Fed was so aggressive, raising rates to get inflation down, we saw the bond market down 13%. So what we measure the bond market by is called the aggregate bond index. And it's got like mortgage-backed securities, treasuries, corporate bonds in that index. And we saw that go down 13% because of all those interest rate hikes. Okay, just think about how that would work. If I own a 5-year bond and it's paying me 2%, all of a sudden interest rates go up, and somebody else can get a 5-year bond paying 4%. Mine's not worth as much. I'm still can hold it and get my principal back in 5 years and get my 2%, but that's it, you know. So that's why bond prices go down in that environment. But back to your question, Lisa, we would probably in this type of environment say, let's move out of stocks, because if we start seeing many companies cutting dividends, we're gonna see the market get pretty volatile. And so what we would recommend is taking that money and just maybe moving over to some high quality bonds to get that 4.25% rate, and maybe even in a shorter, maybe 2 to 3 year term, because eventually we might want to get back into those stocks. But that's where we're going to keep a close eye. That's what Laura has done over the years too, is keeping clients in that balanced mix of bonds. So maybe if you're 70% stocks, 30% bonds, maybe we go to 60-40 or something of that nature. So and that's going to be more on a client by client basis on that allocation. Any other questions specifically on that, or any more discussion or statements, comments? Yeah,
This
Chris.
is related to what you were talking about, the bond market. Are power generators, i.e. utilities, still considered the widow's friend?
Yeah, very good. You know, they're not the widow's friend when interest rates are going up aggressively. That was another sector in the stock market that just the bottom fell out of. What Chris is commenting on, I like that. I don't think I've heard of that. The widower's friend is, we tend to buy utility stocks because they're very stable. Most utility companies aren't going bankrupt. So, because a bad or, yeah, really, a bad or good economy, we are, as humans, gonna turn on our air, we're gonna turn on our heat, we're gonna turn on our lights. So utility companies are pretty steady through a bad or good economy. What's great about utility stocks, they pay good dividends. So we can find utility stocks paying us 3, 4, even 5% in income. But if I can go and get a bond paying 3 or 4 or 5%, I've got the same income with a lot more safety. And so that's where we could see, if they get aggressive at raising rates, those utility stock prices come down a bit. Great question. So kind of wrapping up, just like I said, to me, the bottom line right now, as the data sits through this first quarter, a little concerned about the contraction, but I do believe it's, you know, a little bit skewed because of some of the action CEOs took in the fourth quarter, the end of last year, and then some of the natural causes that we've seen due to weather or natural disaster. So I'm paying close attention to that, and we'll see how it ends up shaping up. The second thing we're paying very close attention to is Washington and what they are going to do with the tariffs, because those will have a negative impact. But at the end of the day, if those aren't broad tariffs, again, what we do have going for us is innovation, AI. Those things will ramp right back up as we get these things settled with Washington. You know, we've got solid corporate earnings, and if we get the rate cut for corporate earnings, that's all going to boost earnings, which will boost stock prices for the year. Any other comments or questions? Or I'm going to stick around and we can have further discussion. I think we can go ahead and turn off the recording though. All right.